it's been a difficult quarter, obviously, for the world. The Iranian-Israeli attacks, U.S. joining in, has certainly sent some shockwaves through the markets. As we know with many of the past military conflicts, sometimes these are disregarded by the market. This time maybe is a little bit different. And really the seriousness of this particular situation is the Strait of Hormuz, as most people are well aware, seeing the price of gasoline at the pump skyrocket. It's really about when the strait will reopen. It's effectively been almost entirely closed to traffic, so it's really been a challenging time. It disrupts supply chains for many industries. So Bob, I'd like your thoughts just in terms of the impact on markets and some of the other asset classes in the first quarter.
Sure. I mean, as you say, it's certainly created a lot of uncertainty globally, this war, and that really stems from the fact that this has broader global implications from a supply chain perspective. When you have, as you say, you have this tremendous amount of oil and other petroleum-related products flowing through that strait, the cascading effect is quite significant, and I think longer term than perhaps people are necessarily appreciating right now. Because yes, you're experiencing that at the pumps already as far as higher gas prices, but I think you have to expect that even if the war comes to an end here shortly, and I know we're in a period of ceasefire at this moment, but even if it comes to an end shortly, the ripple effect of how long that will take to bring supplies back to normal levels is quite significant, because you're talking about often month-long journeys for these ships to get to their ports of destination. So when you think about it in that context, that's where this starts to have broader concerns for the global economy. And if you think about what's happened in the first quarter, I mean, you've certainly seen higher volatility for sure in the market. What that's translated into is, of course, higher returns or higher prices in things like energy and pipeline stocks. So that's benefiting, and we're seeing that in our portfolios. You're seeing gold prices rebound off of some lows, or some recent lows. And again, that's, I think, in response to some degree to the uncertainty of this war. And then other parts of the market being somewhat more impacted. But if you take it as a whole, at least in looking at North American markets, really there's been a fairly muted impact. And you've seen a little bit of a spike in interest rates at the longer end of the curve, but broadly lower impact. And certainly if we look at our own client portfolios and our strategy, we've ridden through this period very, very well.
Yeah, it's interesting. I think if a lot of us, if you'd sort of said 30, 90 days ago, whatever, that there was going to be a massive attack in the Middle East, how would markets react? I think we would have expected a much more severe sell-off. And I think part of that, unfortunately, is investors are sort of getting accustomed to working through. I mean, we've been roughly 4 years with the Russia-Ukraine conflict, and obviously markets have skated through that with really a few blips along the way. And I think this most recent one really highlights the fact that many investors really believe that ultimately President Trump is going to back away from some of his most severe policies. We saw that with the whole tariff situation, and now we're seeing it once again. I did want to just touch on, you mentioned that bond yields have risen a little bit. Why is that happening?
Well, I think it largely stems from expectations of higher inflation. Right? That's a big driver of the longer end of the yield curve. So of course, if you have higher energy prices, higher oil prices, and that's sustaining for a longer period of time, then you have to assume then that inflation will remain higher for longer. And I think pre-war, pre-Iran war, that there was an expectation that we were on this continued trend of lower interest rates. Certainly, the Fed and the Trump administration were kind of heading in that direction to some degree. Now, our view has been that really we're in a period of really higher for longer interest rates, and this just simply supports that thesis further. But that's really what's been happening in the last little while is that uncertainty in the market, and then this expectation of somewhat higher inflation for a period of time is driving higher yields at the long end of the curve. For us, of course, we have tended to be lower in duration in our bond portfolios, which meaning shorter maturities in our bond portfolios, and that's really protecting our clients, their capital and their short-term returns.
Yeah, absolutely. And I guess the question of the day, we're just a couple days sort of into a fragile ceasefire that was announced. Markets sort of were rebounding a little bit in anticipation of that coming, and then once it was announced, markets had a nice little jump. Mm-hmm. We've had a little blips already in terms of the conditions of the ceasefire. So I think a lot of investors are going to be asking, so where do we go from here? I think it's going to be certainly a volatile period of time. From what you sort of hearsay, the demands of the Iranians may not be, certain conditions might not be overly acceptable to the U.S. Mm-hmm. On the other hand, I think there's a real incentive for the U.S. to get this over and done with. It's certainly not helping Trump's approval ratings and that of the Republican Party, and obviously heading into critical midterm elections later this fall. I think they're going to want to see some sort of resolution fairly quickly here.
You would think so. I think it's unclear what the administration's end goal with this war was. I mean, they've certainly had impact on the Iranians, considerable impact on the Iranians and many lives. Whether it's really addressed the concern around uranium enrichment for the long term, big question mark. What it has done is demonstrated that this kind of choke point of the Strait of Hormuz is a real weapon that the Iranians seem to be able to use and may be able to continue to use long into the future, at least as a threat to their neighbors, many of the other Middle Eastern countries that are being impacted by this, other exporters. But more broadly, that's a big concern. And now they're talking about applying transit fees or a tax, if you will, or whatever you want to call it, but a significant additional fee just to pass through that strait, which is against really international law, but would appear that they're not too concerned about that right now. But it does, I think, again, point to there's no short-term end or cessation to all of these issues, and that we're just somehow going to get back to normal tomorrow once there's an agreement with the Iranians and the U.S.
Yeah, I think the fact that this conflict's dragged on for more than 30 days now, initially I think people thought if it was a quick in and out, quick resolution, that oil prices would come right back down to $60 where they were right before the attacks. But now everybody's sort of thinking that there's going to be a significant premium still in oil. Who knows where it's going to end up? I mean, $80, $90. There's been some permanent damage to some of the Middle Eastern energy infrastructure. A lot of countries, because they ran out of storage, they've had to shut down production. And these things aren't as easy as just turning a tap on again and getting oil to flow. It can take a number of months. So to your point, even if we see a successful resolution in the next week or two, it's going to be several months of continued disruption, and we're going to continue to see some inflationary pressures for a number of months. And as you talked about earlier, that sort of puts the central banks, the Bank of Canada, the Fed, in a little bit of a bind in terms of monetary policy and rate setting.
No question, no question. I think, one of the messages that I think that's important for our clients and investors generally to take away from this type of situation is that we go through these periods of heightened uncertainty, and there's no question this is a significant one we're in right now. But what is so important from an investing perspective is to not get caught up in the emotion of the circumstances that are playing out, but to look at and make prudent decisions based on the facts, based on the true information that's there. And unfortunately, there's so much noise in the press and so much noise out there that it's hard to find that truth. But that's what we're here to do, right? That we're here to look at the probabilities of particular outcomes and position our client portfolios in a way that we think is most beneficial to protecting them for the long term. And so that's what's critical here. Don't make short-term emotional responses to these periods of uncertainty.
Yeah, obviously we didn't predict the war. We didn't know that a significant major event was going to hit. But what we do know is that these things will happen from time to time, and that's part of why we construct the portfolios the way we do, making sure that we don't have too much exposure to any one sector, so that if one sector gets hit hard, it doesn't ruin a portfolio. As you said earlier, we've got components of the portfolio that are offsetting some of the hard hit sectors with some benefits. Things like some of our private investments, global real estate infrastructure. It's actually held up very well this quarter, and at a time when public market indices have dropped a little bit. So it just sort of reinforces our core principle of a high level of diversification.
Right. I would add things like gold. Our gold exposure for our clients, our energy exposure have really been dampeners or beneficiaries of this unfortunate situation.
Yeah, and I think longer run it may ironically benefit Canada, because Canada is a secure source, a stable political country for oil and natural gas, and I think many countries that are now facing shortages from this disruption may look to other countries such as Canada for future supply. And again, the Middle East has always been a source of tension and a bit of a powder keg that can go off at any time. So this is going to be another lesson, I think, that people do in terms of diversifying their suppliers, that sort of thing.
Well, it would be great if Canada and our governments came together and really positioned ourselves in a place that we could be seen as this stable source of these critical commodities to the global economy.
Well, Prime Minister Carney has certainly been doing his duties, traveling around the world, trying to establish new relationships, forge partnerships that we've had in past years that maybe faded a little bit. Interesting enough, he's now one seat away from a majority government, with the by-elections coming up next week. So I think we had a significant defection from the Conservative Party. One of the long-standing, almost hard-nosed conservatives, so to speak, came over to the Liberal Party this week. And I think that really sent a message that maybe some of the steps that Carney's doing are amenable to people that normally lean conservative, but maybe he's got a little bit more of a centrist type of approach here.
Yeah, I hope so. I hope he's trying to draw consensus from all parties. I think the Conservatives are contributing to that, or providing an input to that. So hopefully he and his government do those things. But the reality is that so much of what needs to be done in Canada won't be done in Carney's next 4 years, we'll call it. We're talking about decade or decades to really put us in a position where we are just very well positioned again in a global context to be this supplier, this trusted, safe supplier of global commodities.
Obviously, Iran sort of has captured the media's attention and a lot of the investor attention in the month of March. But we also can't forget that there's some significant themes going on behind the scenes, so to speak. So the build out of AI is still a really big one. You've got the big hyperscalers continuing to make massive hundreds of billions of dollars of investments into building out data center infrastructure. That's all good for the economy. But interesting enough, it's been a little bit of a difficult period for technology stocks and some of the software industry in particular. What's going on there, Bob?
Well, I think there's a few things at play, really. I think with some of these big hyperscalers, you take a Microsoft as a great example of that, and Amazon and some of these other big players, there's been a rotation away from some of the big mega cap names in the market, not because of a weakening of kind of this AI boom that's going on, but a broadening out of the market certainly has been an element of that, right? So where capital has flowed out of the big cap or out of the technology sector into some of the other sectors of the market, that in itself is actually healthy. What it's done for some of these big cap stocks like a Microsoft has actually made them much more reasonably priced. So I think from our perspective, these are good opportunities, frankly, to deploy more capital into some of these really high quality names that'll continue to benefit from this significant shift into the use of AI in really all aspects of our economy. Beyond that, I think there's a worry though that AI is some scary HAL kind of outcome that's waiting for us, and of course there are worries that we need to be concerned about, and I think there's a lot of commentary around that. But I think it's what it's also done is created this concern that maybe all these other software applications will just simply be replaced by AI, and I think that's really overblown, but it's certainly carried across the entire sector of software in certainly in North America, if not more broadly than that. And so that's I think a period of kind of rebalancing to kind of where everything gets sold, and then kind of calmer minds or calmer heads come to play, and they start to see, well, what are these businesses, what are the softwares perhaps going to be dislocated by AI type capabilities, and what are really just embedded capabilities that'll last for the long term. Like some of these applications, like Workday, for example. I mean, they take years to implement into these large organizations. They're not going to be ripped out tomorrow and somehow replaced by Grok, right? It's just not a reasonable outcome. So again, it comes back to this whole point of emotion versus fact and prudent decision making. And so you have to look through that, and frankly, what that creates for us is often these opportunities, right, to redeploy capital into opportunity.
Yeah, it's interesting. We went through a period of time there in January, February, where some new AI tools came out, and all of a sudden the gut reaction was the entire white collar workforce was going to be eliminated tomorrow.
Yes.
And that's certainly not going to be the case. There's going to be disruption. There are going to be certainly companies, industries that change going forward. But I think as our investment team looks at AI, and it's certainly something that we focus on all the companies that we're investing in, are the companies that are at the forefront and using AI to look at ways of improving their businesses, whether it's revenue generation, whether it's productivity enhancements. Those are going to be the winners. And there's obviously going to be businesses that maybe don't have a great business model, don't have the visionary leaders that they need to have to embrace AI. And I think those companies are certainly vulnerable.
As they often are in most industries, right? I mean, the reality is the weaker tend to, at some point, get disintermediated by some factor that's playing out. And in this environment, yes, so some players, some software, some companies will be damaged. Some employees will lose their jobs because they can be easily replaced with AI. But from what we see so far, well, there's two things I think you see so far. One is that the impact of some of this AI capability and some of its application seems a bit overstated, right? Like they're a little ahead of themselves as far as what their capabilities are truly able to deliver. But what you are seeing that's really powerful is the productivity lift, right? We see it in our business. You see it in your team on the investment side. We see it in all aspects of our business today and how we've embraced AI in many areas. And you're seeing that even in the software world, right? Like you look at a company like NVIDIA. I mean, it's not that they've somehow just now purged half their coders, half their software developers. They've just made those people so much more effective that they can develop their software so much faster with less bugs, less issues. And so the whole curve of development, software development, technology development is just turning exponential, right? And that's one of the great elements of AI, and you're seeing that in healthcare, you're seeing that in a lot of other areas too.
Yeah, I mean, the reality is this is the way the human race continues to evolve and go forward, whether it was the industrial age, whether it was the internet coming on, and I think AI is just sort of the next and perhaps the most powerful of these forces to come.
Certainly looks that way, and I think you're seeing some sign of some prudent decision making by some of these players, like some of the things that have come from Anthropic most recently that say, like, we're going to put guardrails on these capabilities, right, so that they're not misused. Doesn't mean that there won't be misuse. There always is. We see that with the internet broadly today, how abused it can be. But I think hopefully between companies and regulation, there's a balance there that the outcome is more good than bad, I guess.
Yeah, it's interesting. Our team obviously has to focus on the impact of things like AI coming into the workplace, the Iranian conflict. But there are also some other issues that we're focused on that perhaps are longer term in nature and that can have a big impact going forward. And certainly one of those, which is now forgotten, was the U.S. Supreme Court ruling that deemed that the vast majority of Trump's reciprocal tariffs were deemed to be illegal. Now, the Republican administration very quickly came in with sort of this 10% tax, which is temporary in nature, and likely they're going to try and find other ways to come up with it. But what do you see the implications of the Supreme Court decision on markets going forward?
The outcome of the Supreme Court was to some degree expected. I think the Trump administration, I'm sure, was doing work behind the scenes to position themselves if they got a negative outcome from that ruling. It's very clear that, and Trump has said this from the beginning, that he loves tariffs. And while there's a lot of talk about taco trades and how he backs away, it almost feels like he backs away at the precipice or the edge of the abyss before, but he certainly goes close to it. And I think with tariffs, they're here to stay. I think that's just a reality. However he can affect them, he will affect them at some level, and maybe it's this sort of more base level of 10 or 15%. I think it leaves a lot of countries, though, with a question of, well, we negotiated a trade agreement with you, so what really applies here now? And so there's just going to be continued turmoil in that context, which is, again, not a positive for global trade. But the U.S. is going to use this, again, as a tax, frankly, on its own people to augment some of the other areas that they've cut their taxes, and particularly what's come through in the big, beautiful bill. So I think in time, and perhaps to some degree already, the U.S. economy is adjusting to a tariff of some level, and we'll see if there's any really long-term implications to that. But it seems like they've largely are adapting to some level of tariff, which again contributes to things like inflation, which we've already talked about. But I think that's. And I would say to you, even if at the end of Trump's term, no matter who the next government is, politicians are rarely revoke taxes. So when Biden came in, he did not revoke some of the tariffs that the first Trump administration had applied to countries like China. So you have to assume that this is probably something that will be in place for the foreseeable future. So it does certainly help some of the financial state of the U.S. because it's not in great shape. Its deficits are larger than they've ever been. It's accumulating at an incredible pace, and that will also have implications for the bond market, particularly the U.S. bond market, in the coming years. But I think you then look at the U.S. as a whole and you say, okay, well, what's going on there? Well, of course, this kind of lots of uncertainty in that market, political uncertainty that continues to play out in that market. But economically, it's still an economy that's growing at a reasonable pace.
Yeah.
It's going to suffer under the impact of inflation, particularly around gas prices. That's a real touch point for the U.S. consumer, and that's much of their economy. But it's an economy that's doing better than most economies. You know, the Iran war is really impacting Europe and Asia much more than it is impacting the U.S. and to a large degree Canada. But the U.S. economy, to use an old term, continues to be what is really the cleanest dirty shirt, right? And so it's far from without its concern or issues, but it's an economy that is, as I said, growing and then has further stimulus coming from what we talked about, which is the AI capital spending boom that's just you know, massive in its scale. And then the big beautiful bill, which is also a stimulus bill that will also continue to help drive the U.S. economy. So when you think about, you know, then where do you deploy capital, certainly in an equity context, the U.S. continues to be a place where, you know, you want to have significant exposure in your portfolios, putting politics aside, right? Just looking at the economics and the market opportunity and the you know, the forces that are playing out there. That's a big part of where you need to be.
Yeah, it's interesting. We obviously complaining about where gasoline prices are in North America, but in Europe, not only gasoline prices, but natural gas costs have soared. There's actually shortages in some of the European countries now. Mm-hmm. And fortunately, Canada and the US are relatively self-sufficient in terms of energy dependence.
As you said at the beginning, like diversification is at the heart of what needs to be done, right? We're a global manager, so we're looking for opportunities globally for both public and private markets, and that continues to win out. And I really believe that will pay, no pun intended, great dividends this year to our clients.
Yeah, these are never fun times for investors, but the reality is we're not experiencing anything different today than we've been through for many cycles, and markets have survived. We feel quite pleased about how our portfolios have held up in a difficult environment in the first quarter, and we feel that we're well positioned for the months ahead of us.